So we are taking up today business interruption insurance, or in other words, loss of profit insurance. So loss of profit is a term which was in news when the COVID-19 was there. You know, during COVID period, lockdown was imposed. And COVID was an epidemic that was across the globe, across the world, not only in India. So almost in all the countries, lockdown was there. And because of lockdown, every commercial institution was closed. May it be a factory, industry, micro unit, shop, school, college, hotel, hospital. Other than hospital, everything was closed, except bare necessities. So during that period, when the unit is closed, obviously they will not earn. There was no source of income. There was no profit at all. So the units which were having fire policy as well as FLOP policy, they filed the claim on the insurance companies across the world, entire world, all the countries. Because the FLOP policy is the same everywhere. Fire loss of profit policy is same. Names may be different, like business interruption insurance or like consequential insurance, but the pattern is same. So when the insurance companies received the claims of fire loss of profit policy, they all repudiated the claims everywhere. Why? No country, no insurance company paid the loss of profit claims during the lockdown. Why they were not paid, that you have to understand. And that I will explain. Actually, what the loss of profit policy is. So let us try to understand what is this policy. Say, is it visible to all of you? Can you see it?
Yes, sir.
Okay, so this is fire loss of profit policy. And for this policy, there are two mandatory conditions. First one, there has to be a fire policy. Without fire policy, FLOP policy cannot be given. So fire policy is called here as material damage policy. It has to be in existence. If it is not there, then it can be simultaneously given with the FLOP policy. So fire policy or FLOP policy are given together. Second condition is, if the claim is paid under the fire policy, then only the claim will trigger under the FLOP policy. If the claim is paid under the fire policy, then only the FLOP policy will pay the claim. आप में कुछ ऐसे लोग तो नहीं है जिनकी इंग्लिश समझ में नहीं आ रही और हिंदी चाहते हो? Everybody is comfortable in English? कुछ ऐसे हो जिनकी समझ नहीं आ रहा हो इंग्लिश में तो वो बता दें. Okay. So these two conditions are there. Fire policy has to be in existence. Secondly, if the fire policy is settling the claim, then only the FLOP policy will settle the claim. These are two mandatory conditions. Now this policy is known by three different names: business interruption insurance, consequential loss insurance, and loss of profit insurance. So all these three names resembles and they are for the same policy. If anybody is asking you the business interruption insurance, don't get confused because this is the same name of the fire loss of profit policy. Yes, but it differs if it is asked with the machinery policy. Then it becomes the machinery loss of profit insurance. Then it is not a FLOP. Mr. Ayush, you have to go on mute. Ayush Sharma. Yes. So in that case, if it is given with the machinery, it will become MLOP, machinery loss of profit insurance. If it is given with the fire policy, then it is fire loss of profit insurance. Now there are 4 ways to sell this policy. First, IAR, Industrial All Risk Policy. So this is a compact policy which is having few sections inbuilt. Means fire, FLOP, machinery, burglary, MLOP. These are inbuilt sections of the Industrial All Risk Policy, and this is given to the corporate sector where the sum insured is more than 50 crores. The second method is fire plus FLOP. So fire plus FLOP policy you can give to the factories and small medium enterprises and other commercial institutions where the demand for fire plus FLOP policy is there. You have to take 2 separate proposal forms. Third method is business protector policy plus FLOP. This I am saying because business protector policy is a package policy, but it does not include the FLOP section as inbuilt section. So when business protector policy is given and somebody is asking for FLOP policy, you can give it with a separate proposal form because the FLOP is not the section of the business protector policy. There may be certain policies with the general insurance companies which are not having FLOP section as the inbuilt section. In that case, a separate proposal form can be filled in and a separate policy can be given because these package policies are already having the fire section. So the first requirement of having the fire policy is complied with. So BPP plus FLOP policy can be given to the educational institutions, to the medical and hotels and offices. The last one is free shopkeeper insurance or any other package policy. But if you are giving to the shopkeepers, shops and showroom owners, in that case this section is inbuilt in the policy and the customer only have to select the section by taking at the proposal form, and there is no need of separate proposal form because this is already a section of the shopkeeper insurance policy. Almost all the general insurance companies are having. If they are not having, then they can give it with a separate proposal form. So these are the 4 methods of selling the FLOP policy. Now, if you are giving it to the shopkeepers, there are 4 conditions. Shopkeepers is a very small segment where the numbers are more but the volume is less. Numbers are more means thousands of shops are there in a city, but their total investment is very less. And if the 100 industries or factories or units are there, their volume of business could be very high. So as compared to the industries, factories, corporate, SMEs, the investment in the shops are very less. But they are also entitled to get the FLOP policy. If you are giving the FLOP policy to any shopkeeper or showroom owners, you have to follow these 4 conditions. First one is sum insured. So to a shopkeeper, the sum insured will not exceed 25% of the fire sum insured. These restrictions are for the shopkeepers only, not for industries, factories or hotels or colleges or nothing. Only for shopkeepers. Because their total investment is very less. In a shop, hardly 40 lakh, 80 lakh, 1 crore, 2 crore, 3 crore, not more than that normally. If some precious items shop are there, jewelry and antiques, in that case it may be 10, 15 crores, but not more than that normally. So the first restriction to shopkeepers or showroom owners is sum insured will not exceed 25% of the fire sum insured. How that will work? Suppose the fire sum insured is 1 crore. If the shopkeeper is asking for the FLP policy, you can give the FLP policy for a 25% of amount, means 25 lakh. Second condition is indemnity period. So to a shopkeeper, you cannot give the indemnity period for more than 3 months. It could be less than 3 months, 1 month, 2 months, 3 months, but not more than 3 months. Because the claim is settled on the basis of the indemnity period, and for the period the loss of profit is paid. Premium rate is fixed, that is 360 rupees per lakh plus GST. This is in case of shopkeepers only. All these 4 conditions are applicable to the shopkeepers only. For industries, factories, corporates, this condition is not there. And the fourth condition is minimum premium is 500 rupees plus GST. Means a FLOP policy cannot be given even to a shopkeeper for less than 500 rupees plus GST. So these 4 conditions have to be followed when you are giving this policy to the shopkeepers. First, sum insured will not exceed 25% of the fire sum insured. Indemnity period will not exceed 3 months. Premium rate applicable is 360 rupees per lakh, and minimum premium has to be 500 plus GST. Now let us understand the FLOP policy. What for this policy is? This policy covers only the financial losses of the risk due to interruption in the business following a loss or damage to the insured property covered under material damage policy, that is fire. Fire policy could be standard fire and special peril policy, it can be a Sukshudyam, it could be a Laghudyam, whatever it is. So when the fire policy is there, FLOP policy can be given, but this policy will not cover anything other than the financial losses. Secondly, in fire policy, you will see the separate sum insured is given block wise. Sum insured for buildings, sum insured for plant and machinery, sum insured for furniture, fixtures and fittings, and sum insured for stocks. So this sum insured could be block wise. Purpose of FLOP policy is to protect the insured against loss of income and profit only. Because for building, for plant and machinery, for stocks, for furniture fittings, fire policy will pay the losses. But fire policy will not pay the loss of income, loss of profit. For that you need a separate policy that is called fire loss of profit policy that will cover the income loss or profit loss. So to whom you can give this policy? Whenever you are given the FLOP policy, you have to see 3 things. First, fire policy is there. Second, proposal business must continue. If the business has closed 2 years or 3 years back, then there will be no activity. You cannot get the FLOP policy. And third, proposal should be earning income or profit. If the unit is closed, there is no income, no profit. If the unit is running, then only the income will arise. So these 3 conditions must be complied with. First, there has to be a fire policy. Second, the unit must be continued. And third, there has to be the income or profit out of that business. Then only FLOP policy will give. Now, how this income or profit is seen? Let us say I have a showroom of Raymond Garments. Now my gross profit is, say, for example, 100 rupees. It may be 1 crore, 5 crore, whatever it is. But for example, it is 100 rupees. Out of this gross profit, my fixed cost and standard charges are 70 rupees. It means I have earned net profit of 30 rupees. So when the gross profit is more than fixed cost or standing charges, it means the firm is earning net profit. And the other situation is just vice versa. If my fixed cost and standard charges are 100 rupees and gross profit is only 70 rupees, it means I have registered the net loss of 30 rupees. Because my expenses, my cost is more than my gross profit. So what is covered under the FLOP policy? Two things are there. So fire policy has to be there. FLOP policy cannot be given standalone. Both policies will run together. Fire policy will cover the material damage, and the material damage of any kind related to the building, property, furniture, fixture or stock are covered under the fire policy. But the loss of income, loss of profit due to any fire insured peril or increased cost of working is covered under the FLOP policy. So you can understand this entire situation by this flow chart. This flow chart says there has to be material damage policy, that is fire policy. In that policy, due to any insured peril, there is an indemnifiable loss. Indemnifiable loss, if it is caused by the insured peril, then it is payable. So that is called indemnifiable loss. And due to that loss, there is an interruption in the process. Maybe the unit is closed. Maybe the production is closed. So it is interrupted. And due to that interruption, there is a reduction in the sales turnover. There is a reduction in the manufacturing. There is a reduction in the output. And due to that reduction, there is a loss of gross profit. So the first part is material damage policy, that is fire policy. And the last part is loss of gross profit, that will be insured under the loss of profit. But the sequence will be the same in all units, maybe any kind of business is there. This flow chart will confirm that under all circumstances, under any kind of business, may it be a shop, micro office or small medium enterprises or factory or industry or corporate, this flow chart would be similar. First there has to be a material damage policy, then indemnifiable loss must be there covered by the insured peril, then due to that there has to be interruption in the production process, and then due to that there is a reduction in the sales turnover, and by all this entire process there is a loss of gross profit. So this loss of gross profit is payable under the FLOP policy. Now how will you get this policy? The first question is you have to calculate the sum insured. Sum insured will depend upon the annual anticipated gross profit. Annual anticipated gross profit means what? Suppose my showroom earned 1 crore rupees gross profit in the previous financial year. Now I want to take the FLOP policy. This is not necessary that I should take the 1 crore rupees FLP policy only. No. If I am planning to increase my business, I can take for 1.5 crore, for 2 crore also. Anticipate it. If I am planning to reduce my business, I want to divert to some other business, then I can take the policy for 50 lakh also, for 70 lakh also. Annual anticipated gross profit. But in this policy, 3 important periods are there. 3 important periods. The first one is policy period, that is as usual. Policy period is 1 year. Annual policy, this is. So 1 year means 12 months. Policy may start from 1st January 2024 to 31st December 2024. So this is a policy period, as usual, which is applicable to all other insurance policies. Second is indemnity period. Indemnity period represents the insured's estimation of the maximum period required for normal business operations to be restored following a loss. The normal period required for operation to be restored. It can be for 3 months, 6 months, 9 months, 12 months, 13 months, 2 years, 2.5 years, 3 years. 3 months to 3 years normally. So indemnity period is always opted by the proposer. This is not suggested by the insurance company. According to the nature of business, the proposer or the insured will select the indemnity period for the policy. Third is interruption period. Interruption period means actual period of interruption starting from the date of loss till the date normal operations has been restored. Means from the date of loss, for how much time the business was stopped, for how much time it was interrupted. That actual period is known as the interruption period. And this actual period could be more or less than the chosen indemnity period. But insurance liability is restricted to lower of the two. Means, if the indemnity period is lower, then the insurance company will pay for the claim of indemnity period. If the interruption period is lower, then the insurance company will pay the claim for the interruption period. Lower of it. You can understand these periods by this image. This is showing the first one is policy period. Policy incepted from January 1 and expire on 31st December. This is simple policy period. Second one is interruption period. There was a loss due to fire insured peril on March 1st. And the business was restored to the normal position on February 15 next year. That means it took 15 months to recover to full stream. While the indemnity period selected by the insured was 9 months only. So 9 months ended from March 1 to 31st December. But by that time the business could not be started. It was started only after February 15. So which period is lower? Indemnity period, 9 months. Insurance company will settle the claim for 9 months only. In other words, you can understand it like that. Because the interruption period could be lower or higher than the indemnity period, but actually the indemnity period and the interruption period both will start from the date of loss. And from the date of loss to the normal recovery, the period will continue. Here the indemnity period is short. In that case, insurance company will pay for the shorter period. If the interruption period is short, then the insurance company will pay for interruption period. For example, in my industry, where I have taken a policy from 1st January 1st to 31st December. On March 1, there was fire. There was fire. It took me 9 months to restart my business. So on 1st January, I started my business full fledged. But my indemnity period selected was only 6 months. So interruption period is 9 months, indemnity period is 6 months, insurance company will pay whichever is lower is indemnity period, insurance company will pay for the indemnity period of 6 months only. Now in any kind of business, there are two kinds of expenses. First, standing expenses. Standing charges means fixed expenses which continue to occur irrespective of production level. Say for example, in my factory there is a fire. Factory is closed. But still I have to pay insurance premium, I have to pay rent of the building, I have to pay salary of my few important persons, I have to pay dividend, I have to pay interest on loan, I have to pay administrative cost, I have to pay vehicle rent. These expenses will continue. Maybe my production unit is closed. So such expenses are known as the standing expenses. But there are other expenses also which are known variable expenses which will vary with the production level. No production, no expenses. Say for example, cost of raw material, freight, electricity, labor cost. These are normally incurred when the production continues. Otherwise, they are not required. They are variable expenses. Only the standing expenses will continue. So these expenses could be determined in rate of gross profit. It depends upon the system of accountancy which the firm is maintaining, because turnover plus purchases will decide what is the rate of gross profit. Suppose the turnover is 10 lakh, closing stock is 20,000, so the closing stock is 10 lakh 20,000. But opening stock is 20,000 and purchases were 3 lakh 50,000, so opening stock was 3 lakh 70,000. It means the gross profit was 6 lakh 50,000. Now this 6 lakh 50,000 gross profit is over the 10 lakhs turnover. So the percentage is 65%. This you can say in other words, it is the amount which the sales turnover exceeds the manufacturing cost. That is called gross profit. When the sales turnover exceeds manufacturing cost, that is gross profit. Sales turnover is 100, manufacturing cost is 60, gross profit is 40. So what is insured under the FRP policy? Gross profit. What are the components of gross profit? It includes standing charges, net profit, increased cost of work. So how to decide the policy sum insured? It depends upon the period of indemnity selected by the proposer. If the period of policy is within 12 months, indemnity period selected is within 12 months, the sum insured should be annual gross profit. But if this indemnity period is more than 1 year, maybe 1.5 years, 2 years, 2.5 years, 3 years, In that case, the sum insured will increase in the same proportion. Premium will be charged double for 2 years, triple for 3 years. Now the question is, what are the perils insured under the FLOP policy? So the first condition is, if the fire policy is there, then only the FLOP policy will be given. And the second is, if the fire policy is paying the claim, then only the FLOP policy will pay the claim. That means all perils covered under the fire policy are also covered under the FLOP policy. Because the loss caused by any insured peril of the fire policy is payable under the fire policy. Similarly, then the FLOP policy claim is payable. Because the FLOP policy triggers that claim is payable under the fire policy. So what are the perils insured under the fire policy? Need not repeat. You know already 14 perils are there. If the standard fire and special peril policy is there, then the 12 perils are there. Maybe the fire policy add-on covers are taken. If the standard fire and special peril policy is there, then the 15 add-on covers are there. Customer may select any number of add-on cover or maybe all add-on covers, but not necessarily. He may not take even a single one. He may take only 3, he may take 6. This is optional. Add-on cover is not binding. So when you are selling a FLOP policy, you need the quotation to generate what basic detail you need to take from the proposer. On the basis of that only the underwriter will generate the quote. So in the basic detail, when you are collecting from the proposer, you need the details of fire policy, basis of accounting, list of standing charges, indemnity period selected by the insured, gross profit registered in the previous financial year, turnover of the previous financial year, whether unit is continuous or non-continuous, and add-on cover if required. So this is the bare minimum information. On the basis of that, the underwriter will generate the quote or will provide it to you. Now there are certain exclusions of the FLOP policy also. The first one is compulsory access. And here the compulsory access is typical, because this is not in terms of money. Here the compulsory access is applicable in terms of time. FLOP policy carries access in days. It is known as the time access, because minimum time access is 7 days. So the intention of access is to avoid small losses and to take some share of loss in major claims beyond 7 days. So up to 7 days there will be compulsory access, means the loss is deducted. Over that, the entire amount will be paid. So any restriction or reconstruction or operation imposed by any public authority is excluded. Lack of sufficient capital or funds with the insured for timely restoration or replacement of property lost, destroyed or damaged is excluded. For that, no claim is paid. Loss of business due to causes such as suspension, lapse or cancellation of a lease license or order is again excluded. Damage to boilers and customizers turbine or other vessels, machinery or apparatus in which the pressure is used, or their contents resulting from their explosion or rupture is again excluded from the FLOP policy. Electronic installations, computers and data processing equipment are not covered under this FLOP policy because they are covered under the EEI policy. Again, damages resulting from the deliberate erasure, loss, distortion or corruption of information on computer system or other record program or software is not covered. Other erasures like loss, distortion or corruption of information on computer system or other records, programs of software, unless resulting from an insured peril, is not covered. Mechanical or electrical breakdown or derangement of machinery or equipment is not covered. And then there are certain add-on covers with the canopy policy also. Means these add-on covers are separate to the fire policy. These are available with the FLOP policy. And these are 4 in number. First, accidental failure of public electricity, gas and water supply. Because if the failure is there, this may delay the restoration program. It means this can increase the actual interruption period. So the insurer has to suffer. Second, damage to customers' premises due to peril covered under the fire policy. Third, damage to suppliers' premises due to peril covered under fire policy. And the fourth is auditor fee. A supplier's premises means, say for example, my bike manufacturing company is there. I have given the order to a third party vendor to supply me the head assembly of the bike. When he is supplying the head assembly to me, my bike is completed, otherwise not. So this third party vendor is living in a separate premises. If there is anything to their premises, means fire, flood, earthquake loss, his work will stop. And if his work will stop, he will not able to supply to me. When I am not receiving the supply, my work is also stopped. So that kind of supplier's premises endorsement he can take, though there is no insurable interest in the premises of the suppliers. And the last one is auditor fee, because this is a loss which is paid on the basis of the books of accounts, whether the actual loss suffered is how much. And for books of account, there are people who are preparing that, like accountant, like Munimji, like auditors, like CAs. So they are charging their fee. That fee is payable only when the add-on cover is taken, otherwise not. So what kind of loss is payable under the FLOP policy? If there is any loss, maybe it is direct or indirect, loss to the stock is there or loss to the property is there, that loss will not be paid under the fire policy. Loss of profit policy payable only the loss of income or loss of profit. But there are options available with the proposer to select the proposer form or select the kind of policy, because there are 4 kinds of FLOP covers. They are decided on the turnover basis, output basis, difference basis, and other basis. It depends upon the number of units, what kind of number of units is there. Turnover basis is useful for the organizations and trading activity or involved in manufacturing. Supply of goods in existing basis with no accumulation of stock. So the reduction in turnover will be used to arrive at the indemnity. Hence, in case there is accumulation of stock, the turnover level may still be maintained. Means turnover basis is useful only for those firms which are engaged in manufacturing. Output is there, turnover is there, though for those only this turnover basis is useful. Second is output basis. When the reduction in the output is used to arrive at the indemnity, thus even if there are buffer stocks, the loss can be worked out as there is going to be reduction in output. So care to be taken in case of multi-production units. The third one is differential basis. So difference basis means gross profit is arrived at on the difference basis. Instead of standing charges, working expenses are covered. So all purchases, laws, documents received in percentage of annual basis, power, consumable stores, carriage, packaging material, bad debts, discounts allowed, any other expenses to be specified. But the specification in this difference basis are used on turnover basis and not on the output basis. So this is another method, difference basis. And the last one is the revenue basis. That is, if the policy broadly follows the pattern of the turnover, or turnover is replaced by the gross revenue or gross fees. In that case, only the revenue basis will apply. Because the revenue basis is for those units where the output is not there, manufacturing is not there. But they are rendering the services like hotels, private schools, nursing homes, solicitors, CA. They are earning the revenue. And they are taking this policy on the revenue basis. Because the money paid or payable to the insured for services rendered in the course of the business in the premises are fee. Money paid or payable to the insured for services rendered in the course of the business of the insured. So these are the four methods available for the customers. Now the under insurance is also applicable to this policy. Because difference in value of stocks at the time of fire and subsequent replacement, and then the depreciation of undamaged stocks after fire is there, bad debts could be there, loss of goodwill could be there, failure to recover book debts due to destruction of records could be there, litigation costs or third party claims could be there, loss of gross property equivalent to time excess could be there. So if they are underinsured, then only this clause will be applicable. So in simple terms, the policy is for the 1 year. It could be for short term according to the requirement. The policy compensates the insured against the loss of gross profit in case of any accident because of the perils operated from the fire policy. Gross profit means sales minus cost of goods purchased. Deductible is not in terms of cash, it is in terms of days, 7 days of gross profit. So there is a decline category also. Decline category is required because wherever you cannot get the fire policy, you cannot give the FLOP policy also. And you know you are not giving the fire policy to the mobile shop, cracker shop, plastic manufacturing units, standalone warehouses, shop stealing and hazardous goods. They are the proposals where you are not giving the fire policy. And if you are not giving the fire policy, you can give the FLOP policy also. I give you a certain examples. When you are giving a FLOP policy, how you will apply the premium rate. Say suppose mine is an engineering workshop, by which I am earning 20 lakh rupees gross profit. I have taken a fire policy with earthquake and terrorism because Sushuddham policy includes them. Indemnity period I have taken 3 months. Earthquake is covered. So the premium rate is suppose 1.08. How the total premium will be calculated? My sum insured is only gross profit, that is 20 lakh rupees. Premium rate is 1.08 per milli, because fire rates are in milli. So 1.08 upon 1000 into 20 lakh. Premium would be 2160 plus GST. Very simple example. That is how the premium will be charged on the policy. Now let us see an example of the claim. Suppose I am running a firm and its gross profit is 30 lakh. I am taking the FLOP policy for indemnity period of 3 months. Fire policy I have taken, which is covering the risk of earthquake also. Flood came and the flood caused the loss to my unit. And due to that loss, my unit was closed for 8 weeks. There was no under insurance. My unit was closed for 8 weeks. Now, how the insurance company will settle my claim? Because my sum insured is 30 lakh, indemnity period is 3 months, fire policy I have taken, flood has caused the loss, flood is covered under the fire policy will pay the claim as well as the FLOP policy will pay the claim. So fire policy will pay the losses for other things which are building, material, furniture, pictures and stocks. But fire policy will not pay the claim for my loss of income. My unit was closed for 8 weeks. 8 weeks means 2 months. My indemnity period is 3 months. So whichever is lower, the actual interruption period is only 2 months, 8 weeks. Indemnity period is 3 months. Insurance company will pay for the actual interruption period, that is 8 weeks. But when insurance company is settling the claim for 8 weeks, the compulsory access as per the policy is 7 days. That means 1 week. So the compulsory access will be deducted from the 8 weeks. That means the claim payable is for the 7 weeks only. Now for 7 weeks, how the insurance company will pay the claim? Policy is for 1 year, sum insured is 30 lakh, and indemnity period is 3 months. 30 lakh is divided by the weeks. There are 52 weeks in a year. So if we are dividing 30 lakh rupees by weeks of 52, it means per week gross profit is 57,962.3. This is per week. We have to pay for 7 weeks because 1 week is compulsory access. So if we multiply 57,962.3 with the 7, the claim payable is 4,03,846. This is the simple method of settling the claim. Simple method. Interruption period and indemnity period, whichever is lower, is payable. Now, if the customer is having fire policy with other insurer, can we sell a fire policy too? Perfect. This is a question very often asked. You may also face such a situation. Your customer wants a FLOP policy, but he says, I have taken the fire policy from New India. Should you give the FLOP policy? There is no restriction at all. You can get the FLOP policy. But the only condition is, you have to take his fire policy. Because you have to check for what amount it is, for what period it is, for what property it is. Normally, the period of fire policy plus FLOP policy is the same. Because suppose the package policy is taken and where fire and FLOP both sections are selected, policy period will be same. Or if a Sukshma Udyam or Laghu Udyam is given on the same date, if FLOP is given, the policy period will be same. But suppose if the fire policy has already run for 3 months and then the customer is asking for FLOP period, then you should preferably give it for 9 months. When the policy expires, both policies will be renewed together to continue for the next financial year. That is the way. So in FLOP policy, what you see? Few important terms which are applicable to FLOP policy only, like indemnity period, inception period, gross profit, add-on covers of different nature. Is there any possibility of multiple claims in one policy year? Yes, nobody can deny. Say suppose one loss is due to fire, other loss is due to flood. And both the times suppose the unit was closed for 3 months. If they are having the policy, fire as well as FLOP, they will claim both the times and the insurance company has to pay. Nothing wrong. So this is all about the FLOP policy. Now you can ask the questions if you have any doubts in your mind.